Hello everyone, welcome to Tesla Daily News. Today is July 20th, Sunday, and the following is the latest Tesla news. According to Süddeutsche Zeitung, Tesla is preparing a major expansion at its German Gigafactory in Grünheide near Berlin, a development with big implications for both investors and Tesla fans. The company's latest 2025 report from Tesla manufacturing Brandenburg SE forecasts a clearly higher production volume in the 2026 financial year compared with the previous year. Capacity utilization is expected to rise, and the factory already supplies more than 30 markets, with more to be added. According to Süddeutsche Zeitung News, Tesla has set a concrete target. It wants to ramp production in Grünheide up to as many as 7,500 vehicles per week, which translates to roughly 375,000 cars per year. This is a substantial increase from the roughly 200,000 Model Y vehicles produced at the site in 2025. To support this ramp, Tesla plans to expand battery cell manufacturing on site and create about 3,500 additional jobs. For the German state of Brandenburg, Grünheide is already the largest industrial employer, with around 11,000 workers including temporary staff by the end of 2025. The Süddeutsche Zeitung report emphasizes that Tesla's strategic goal is to concentrate the entire value chain in Grünheide, from battery cell all the way to the finished vehicle. Tesla describes this as unique in Europe. For investors, this matters because vertical integration can reduce costs, improve margins, and make the European business less dependent on external suppliers. It also signals Tesla's commitment to Europe as a long-term manufacturing and export hub. However, according to Süddeutsche Zeitung, there are caveats. The expansion of the factory has been, and remains, linked to overall market development. Tesla also benefits from renewed state subsidies, which support the economics of local battery and vehicle production. At the same time, Tesla warns that continued geopolitical tensions, potential supply chain disruptions, and the cost disadvantages of European cell production relative to the United States and China pose meaningful risks. These factors could slow or limit the full build-out of the planned battery value chain in Grünheide. From a financial perspective, Süddeutsche Zeitung notes that the Tesla manufacturing Brandenburg SE subsidiary closed the 2025 financial year with a net profit of 77.1 million euros, an improvement of about 20 million euros over 2024, despite a challenging market for electric vehicles. Capacity utilization was around 54%, slightly lower than the 56% reported a year earlier. Interestingly, revenue fell from about 7.7 billion euros in 2024 to 7.1 billion euros in 2025. This decline was driven largely by lower production costs and a temporary dip in output tied to a model changeover and the integration of new variants. In 2025, roughly 202,000 vehicles came off the lines in Grünheide, around 9,000 fewer than in 2024. Even so, Tesla describes the output as a stable production level that sets the stage for the planned ramp. For stock investors, the Grünheide story suggests a factory with significant unused capacity, improving profitability, and a strategic push to become Tesla's integrated European hub. The key questions will be whether market demand, subsidies, and regulatory conditions support reaching that 7,500 per week target, and whether European cell production can be made competitive versus other regions. According to NTV, which closely echoes the German business press, Tesla's Grünheide plant has become a clear profit engine even as overall unit volumes dipped last year. The channel reports that demand for electric vehicles is picking up again, providing a tailwind for Tesla's German production targets. The company itself forecasts a strong increase in production volume for 2026, underpinned by rising capacity utilization and an expanding list of more than 30 export markets. NTV mentions that the planned ramp to 7,500 cars per week is inseparable from expansion of battery cell production at the same site. Tesla again emphasizes that bundling the full battery and vehicle value chain in Grünheide is, in its view, unique in Europe. The subsidiary's net profit of 77.1 million euros in 2025, up about 20 million year-on-year, came even as revenue dropped to 7.1 billion euros from 7.7 billion. Output slipped from roughly 211,000 to 202,000 vehicles, largely due to model updates and integration of new versions of the Model Y, which remains the sole model produced there. According to NTV News, Tesla outlines the same set of risks: escalating geopolitical tensions, potential supply interruptions, and structural disadvantages for European cell production compared with the US and China. The company explicitly ties the full realization of the battery value chain to favorable economic conditions, underscoring that policy support, energy prices, and supply chain stability will significantly influence how far and how fast Grünheide can grow. For Tesla enthusiasts, the NTV coverage reinforces that Grünheide is not just a local plant but an increasingly important node in Tesla's global manufacturing network. For investors, the combination of rising profitability, planned capacity jumps, and explicit government support, balanced against clear macro risks, is a critical data point for assessing the strength and volatility of Tesla's European earnings stream. According to Tagesschau, Tesla's German expansion is closely connected to improving performance at the Grünheide site and a return to stronger overall profits. The outlet reports that Tesla expects renewed million-euro gains, driven in large part by the German plant's operations. This financial momentum is one of the reasons Elon Musk now plans to push ahead with a further build-out of the factory. Tagesschau mentions the same core targets. Tesla wants to achieve weekly production of around 7,500 vehicles from Grünheide, equivalent to annual output near 375,000 units, and intends to create roughly 3,500 new jobs. The company also wants to deepen its battery cell manufacturing so that the entire value chain, from cell production to final vehicle assembly, is located on site. Again, Tesla describes this fully integrated setup as unique in Europe and notes that expansion has been, until now, tied to market development and is supported by renewed state funding. According to Tagesschau, the company reiterates the geopolitical and macroeconomic risks that could affect the pace of investment. It warns that higher tensions and supply chain interruptions could negatively impact production and profitability. In 2025, the Grünheide subsidiary still managed to raise net profit to 77.1 million euros, while capacity utilization stood around 54%. Annual output of about 202,000 vehicles was slightly lower than the prior year, largely due to a model refresh and new variants of the Model Y. Revenue dropped from 7.7 to 7.1 billion euros, but lower production costs cushioned the impact on earnings. For investors following Tesla's global capacity story, Tagesschau's coverage confirms that Grünheide is expected to play an increasingly central role in Tesla's profit mix, even if unit volumes fluctuate due to product cycles. For enthusiasts, the implications are more models, more localized production, and a more robust European base, albeit with ongoing debates over environmental impact and water usage in the region. According to Der Spiegel, Tesla's German expansion plan is not only about more cars and more jobs, but also about positioning itself strategically within Europe's industrial landscape. The magazine summarizes Tesla's intention to raise Grünheide's output to around 7,500 vehicles per week and to expand battery cell production, ultimately adding about 3,500 new positions. Der Spiegel mentions that Tesla explicitly wants to bundle the entire value chain, from battery cell to finished car, at the Grünheide site. The company points to this integrated approach as a special position within Europe's automotive sector. Up to now, further expansion has been linked to market development, but Tesla also benefits from renewed state subsidies. At the same time, the article notes that Tesla acknowledges uncertainties stemming from geopolitical conflicts and the broader macro environment, which could influence both demand and supply chains. For stock investors, Der Spiegel's emphasis on value chain consolidation and special status in Europe signals a long-term bet on European manufacturing and exports. It also underscores a key theme: Tesla is not just expanding capacity, it is attempting to anchor critical technologies, like advanced battery production, inside the European Union. This could become a competitive advantage if supply chains fragment further along geopolitical lines. According to Zeit Online, Tesla's expansion plans at Grünheide also include a drive to tap into additional export markets from its German base. The outlet reports that the company's 2025 business report for Tesla manufacturing Brandenburg SE forecasts clearly higher production volumes in 2026, together with a rise in capacity utilization. More than 30 markets are already supplied from Grünheide, and the list is expected to grow. Zeit mentions that the article is being updated and at the moment focuses on the production ramp and market expansion rather than financial details. Taken together with other German coverage, it reinforces the view that Grünheide is evolving from a primarily regional plant into a pan-European and possibly global export hub for Tesla, particularly for the Model Y and any future variants or models produced there. For Tesla fans, this means that cars produced in Germany will likely be seen in more and more markets, influencing how the brand is perceived across Europe and beyond. For investors, broader export reach from a single, highly automated plant can improve economies of scale and support margin resilience across different demand cycles. According to Handelsblatt, Tesla's expansion in Germany is closely tied to state support and a clear strategy of full value chain localization. The business outlet reiterates the company's aim to ramp Grünheide's output to 7,500 vehicles per week, expand battery cell production, and create around 3,500 additional jobs. Handelsblatt mentions that Tesla again highlights the uniqueness of having the entire chain from battery cell to completed vehicle on one site in Europe, calling it a differentiator versus competitors who rely more heavily on dispersed suppliers. The paper also notes that the expansion had previously been tied to market development, and confirms that Tesla profits from renewed government subsidies, which improve the business case for such a large-scale project in Germany. For investors, Handelsblatt's focus on subsidies and value chain integration underscores two levers that can materially affect Tesla's European margins: policy support and operational efficiency. Sustained subsidies and successful ramp-up of local cell production could reduce reliance on imported components and support higher long-term profitability from the region. According to Economx from Hungary, Tesla's Grünheide expansion is being driven by a combination of improving financial results and rising demand for electric vehicles across Europe. The report explains that, based on Tesla Manufacturing Brandenburg SE's 2025 business report, the company plans to significantly increase production capacity in the coming years, expand battery cell manufacturing, and enter new export markets from its only European plant. Economx mentions that Tesla wants to lift weekly production to roughly 7,500 vehicles, allowing for around 375,000 electric cars annually. This scaling effort is expected to bring approximately 3,500 new jobs to the region, adding to the 11,000 employees already on site at the end of 2025. According to Economx News, Tesla's long-term goal is to concentrate the full production process, from battery cells to final assembly, at a single location, reflecting its broader strategy of deep vertical integration. The outlet notes, however, that the expansion is not guaranteed. Tesla warns that investment timing and scale will depend heavily on market and economic conditions, including geopolitical tensions, supply chain disruptions, and the competitive disadvantage of European battery manufacturing versus the United States and China. On the financial side, Economx reports that Tesla Manufacturing Brandenburg SE achieved a net profit of €77.1 million in 2025, about 20 million more than in the previous year. At the same time, revenue slipped from €7.7 to €7.1 billion, and the number of vehicles produced decreased from roughly 211,000 to 202,000, largely due to Model Y updates and the introduction of new variants. For investors, this combination of higher profit with slightly lower revenue reflects both cost reductions and an underlying efficiency improvement that could be leveraged further if volumes increase. Shifting from Europe to Tesla's global technology ambitions, according to the International Business Times, Tesla has unveiled a striking fleet of gold-colored autonomous vehicles, signaling a major push toward commercial robotaxi services. The report describes multiple Cybercab prototypes navigating a test track, suggesting progress toward fully driverless operation and bringing renewed attention to Tesla's autonomy roadmap. According to International Business Times News, Tesla continues to position Robotaxis as a cornerstone of its future growth strategy, aiming to create high-margin revenue streams that go far beyond traditional car sales. Elon Musk has repeatedly argued that full self-driving technology could transform the company's economics, and Tesla has invested billions of dollars into artificial intelligence, neural networks, and proprietary hardware to support this vision. The outlet explains that Tesla's approach relies primarily on camera-based perception, supported by advanced neural networks trained on enormous volumes of real-world driving data collected from its global fleet. Unlike some rivals who combine cameras with LiDAR and other expensive sensors, Tesla is betting that a vision-only system will prove cheaper, more scalable, and ultimately more adaptable across many markets. International Business Times mentions that the golden robotaxi fleet appears at a time when the broader autonomous driving industry is still wrestling with safety concerns, regulatory scrutiny, and technological hurdles. Competitors like Waymo and Cruise have deployed robotaxis in limited geo-fenced areas, but widespread commercialization remains slow. Tesla aims to differentiate itself by leveraging mass-market production, its existing customer base, and potential network effects. Owners of compatible vehicles might one day be able to add their cars to a Tesla-run ride-hailing platform, generating income while increasing the size and coverage of the network. For stock investors, International Business Times emphasizes that success in robotaxis could significantly boost Tesla's valuation. Software-driven services often have much higher margins than hardware sales, and a global autonomous network could be worth hundreds of billions, if not more, if it scales successfully. However, the article also notes the substantial challenges: regulatory approval for unsupervised driving across varied environments, the need for compelling safety data, and reputational risks from any high-profile incidents. According to the report, Tesla's Dojo supercomputer and its vertically integrated approach to hardware and software give it an edge in training and deploying large AI models. The company continues to expand its AI talent pool and compute resources, seeking to shorten development cycles and roll out improvements over the air to customers' cars. At the same time, International Business Times notes that Tesla has faced criticism for its full self-driving branding and marketing, with some regulators questioning whether the term might mislead drivers about the capabilities and limitations of the system. The company responds that its software is consistently improving and that the enormous volume of data from its global fleet provides a self-reinforcing advantage, as each mile driven helps refine the neural networks. For Tesla fans and technology enthusiasts, the golden Robotaxi fleet is both a powerful marketing symbol and a tangible sign that Tesla is pushing ahead on autonomy. For investors, the key takeaway is that Robotaxis remain central to the long-term Tesla story and could, if executed well, transform the company into a leading global mobility platform. Turning to Tesla's expansion into new geographic markets, according to latest LY, the company has completed its first year of official operations in India, with results that highlight both potential and serious challenges. The report states that Tesla registered 486 vehicles in India in its first year, from July of last year to mid-July this year. According to latest LY News, Tesla's Indian presence is currently based on a cautious, premium-focused strategy. All vehicles sold so far have been imported Model Y units from Tesla's Shanghai factory, and the company has not yet established local manufacturing or assembly lines in the country. Tesla operates a high-profile experience center in Mumbai, but its overall retail and service footprint remains limited. Latest LY mentions that this import-only approach has exposed Tesla to very high import duties on fully built cars, which inflate retail prices and place the Model Y firmly in the luxury bracket. In a market as price-sensitive as India, this sharply narrows the potential customer base. In addition, the company currently offers just a single model in the market and has a relatively sparse service network, factors that make the brand less accessible and less convenient for customers outside a handful of major cities. According to the article, Tesla faces stout competition from established premium and luxury brands that have invested for years in local integration and wider product lines. Companies like BMW, Mercedes-Benz, Volvo, and BYD offer broader portfolios, deeper dealer networks, and, in some cases, local production, enabling more competitive pricing and better after-sales coverage. For investors, latest LY underscores that Tesla's first year in India, with fewer than 500 registrations, underlines the importance of localization if the company wants to tap into the world's fastest-growing large car market. Without local assembly or production, high tariffs are likely to keep volumes modest. Potential future growth would require decisions on building or partnering for domestic manufacturing, expanding the charging and service network, and possibly introducing models tailored to India's pricing and infrastructure realities. For Tesla enthusiasts, the India story is still at an early stage. The brand's arrival generated significant excitement, but the numbers so far reveal that a premium, import-only strategy can only go so far. Whether Tesla becomes a meaningful player in India will depend on how quickly it chooses to commit capital and engineering effort to local solutions. Taken together, today's news paints a picture of Tesla advancing on several fronts at once, ramping a key European factory and deepening its value chain integration in Germany, pushing forward ambitious robotaxi and AI plans with a visually striking new fleet, and probing new markets like India while grappling with structural and regulatory challenges. Thank you for listening to Tesla Daily News. If you enjoyed this episode and want to stay updated on the latest developments in Tesla's global journey, please subscribe and join us next time.